Good morning and welcome to this impromptu. We decided to call it impromptu Connect and Grow webinar, where I just want to use an event that doesn't happen that often and it's quite timely, it's time sensitive, to just make a few points and just have a look at where we've come from in the markets, but in particular the US portfolio, and then get some learning from this and just take the opportunity right now when it's happening to do that and just emphasize some points. So I'll quickly go through some charts of US indices and the Australian index, all ordinaries, and then have a look at the two US portfolios that I manage with real money. Before we do that, I have to tell you that everything we cover here today is general investment advice, and there's no personal or specific investment advice. Right, into it. Let's have a look at the All Ords. And what I'm going to focus on here, just to set the scene, is I use, as I've told you before, either a dotted or a full rectangular zone, and those zones are support and resistance zones. And what we're looking at here, the theme will be all of the, and I typically use a color black for all-time highs, and I keep it there for some time until there are a number of touch points at a new zone to be able to say, right, this is now the new all-time high resistance zone or support zone, and then I'll take this black one and I'll make it into a solid blue. So that's what we're going to be looking at. We're going to be, just to get trained eye, we're going to be looking at these zones, these all-time high zones, and just getting a feel for how far, firstly, that there's been a breakout, and secondly, how far the price action in these indices have moved above what was previously a resistance, all-time high resistance zone, and now become support zones. So this is the all ordinaries, and it's obviously made a new all-time high. It come down, tested it, and now bounced off that. So this is classic stuff. This is resistance, 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 breakout, support, breakout. This is classic technical analysis, classic price action, and we really cannot ignore this. Sure, there's no 100% dead cert that it's going to just take off and keep going. That's risk. That's what we have to manage and get very comfortable with and embrace, to really become peaceful and unflappable as a trader in the market. So that's the all ordinaries. I also keep a relative strength line here measured against the S&P 500. And what that typically does is when the blue line is rising, that means that the All Ords is outperforming the S&P 500, and typically that happens during more negative market periods. And when the All Ords is underperforming, falling like this, when underperforming the S&P 500 like it is down here bottom right hand corner, that's typically a risk-on environment. The S&P 500 does a bit better than, or there's bull markets in place typically around the whole world. Right, let's get into the US markets. The Dow Jones, I've made a big noise about this ever since that breakout occurred back here. Breakout, test, support. So that's resistance, come back, test, support, continue up, and now a very strong price action in the 30 largest companies, roughly the 30 largest companies in the US, and a couple of internationals there as well. And also very typical of a bull market is when the Dow Jones underperforms the broader market, which is what's happening here at the moment. So breakout, consolidation, and more and stronger rises now happening in the Dow Jones. The same with the broader market, the S&P 500 now getting well above the previous all-time highs. Right. So what we have, one big main point to make here is that this is the movement in the major indices has been too far for this to be a range extension. What's a range extension? Well, typical of a secular bear market, like we had from 2000 to 2013, is those tests. When an all-time high gets tested, sometimes the price breaks out just a little bit and then falls back into the range. And that little bit of a breakout is just maybe buyers getting in a little bit too early, thinking this could be, the breakout that goes to higher price. And you'll see this in stock price action as well, not just indices. And that range extension typically happens when the sideways market hasn't completed yet. And that would happen. You'll see it happen in indices, where the range extension goes out, and you could call it a false breakout as well, moves back into the range, and then you continue with the sideways consolidation or just really resistance. This is not happening here. This is not a range extension. The S&P 500, the Dow Jones, the DAX, and we'll see in a moment, the NASDAQ 100 are just too far above their previous all-time highs to call this a range extension. So I'm going to call it now that even though not all the indices are there, is that this is stronger than a range extension. Sure, no dead certs. Everything could reverse and fall in a heap and fall back into the range. But the further this gets away from the all-time highs, the greater the probability is that this is the start of another pretty strong bull market and the continuation of the secular bull market that I discuss every 6 months or so. So this is key. Now, this also brings into perspective some of the wall of worry commentary that's been around for 2 years now. And the point about this wall of worry commentary that really stood out to me over this period are the number of historical bulls, i.e. not doomsayers and perennial bears. So a lot of the bulls, and one in particular is Stanley Druckenmiller, who is not a bear, right? He might not be a raging bull all the time, but he's certainly not a doomsayer bear. And he called this, back over the last 2 years, a long-term sideways, potentially 10-year movement in indices. And of course, the bears have done, and there have been some other people you may not be aware of who are typically bears or even neutral that were saying that, typically bulls or neutral, that were calling this long-term, like the Japanese market, like the Nikkei did for 40 years. So this is significant, and it's also another reminder to us that we mustn't get sucked into noise. We've got to follow the price action and be objective and open-minded, and anything can happen, and that's what we've got to focus on. Focus on process and get our minds in sync with focusing on price action and not listening to the noise. So let's keep on having a look at the indices here. This is the NASDAQ composite, just a smidgen to an all-time high that it made on yesterday's session, a wee bit higher today, but the sellers ended up in control, mainly to do with Apple falling quite a lot, with some legal action going on over there as a short. Well, we don't know. It might turn into longer term, but certainly that was an event that occurred today that affected that. But that's led into a red bar, a red candle on the NASDAQ composite, but nevertheless a breakout. And when I had my last session last week, every couple of weeks when I look at the markets, just spend half an hour looking at that, was the message was keep an eye on the NASDAQ composite. And it's had that breakout, gone to a new all-time high, but is going to face a little bit of resistance in the short term. We'll see how that plays out. So NASDAQ composite above, the NASDAQ 100 certainly well above its previous all-time high level, like the Dow Jones and like the S&P 500. So becoming more and more lower probability being range extension. This looks like a pretty important and continuation of the secular bull market. The other one that's come to the party, which I've been talking about for some time, is the mid cap, the S&P 400. That's also made an all-time high and breakout, come down, test previous resistance, now support, and made another new all-time high. The other one we're waiting for, which hasn't made its new all-time high yet, is the small caps, the dollar SML small cap, the S&P 600 is another name, and that could be seen. Now, if you've got a negative mindset on this, people could use that subjectively to say, the small caps aren't there yet, this is not a breakout. But on the other hand, you could see it as an opportunity and say, well, they're going to catch up at some stage. I leave that to you, but just making those points. So I'm not going to go. The Nikkei is also at all-time highs. So is the DAX. And now what I'm going to do is translate that into what's happened in the US public portfolio, the unleveraged public portfolio. I'm just going to have a look at its equity curve and talk a little bit about that, and just try and take some context of what's happened over the last 2.5 years, and a lot of the negativity is around, and what got us to do even go into doing a whole bunch of new research. So that is the top line. The blue line is the US portfolio. It's real money portfolio, and it's just made a new all-time high. I've got the black line there that shows its previous at $190,000, 150, I think it was $190,150, and went into some serious drawdown here. This bottom curve is the underwater curve, or the drawdown curve, which is available to everybody to look at in their portfolio manager. And we had this deep drawdown over here, and we've had this run up out of drawdown, and now just made a new all-time high. Now, there was a post that Dave put on the forum yesterday about this. Not many people are tuned into the forum, but if you do get notifications, you'll see emails that come, and there's some important points that we make on forums, and it is certainly as a learning tool. So we'd ask you to turn notifications on and have a look at that. There are discussions they have about performance, and there's also a recent one being about CSR with the 20-day rule. But there are not a lot of posts that go out there these days, but it certainly is a learning tool. So I'd encourage you to turn on notifications and have a look at the stuff that comes through in the forum from time to time. But the important point here is that this US portfolio has made a new all-time high. So what do we take from that? Now, during this period of time, and I've written a new eBOOK about this, which will be going out pretty soon. But this type of period here, from those who are unskilled, I'd say unskilled, who haven't yet got an unflappable, peaceful mindset about how to invest, this sort of period just turns people right off. And that's what we have to overcome. That's one of the major risks. Mark Douglas talks about the 4 primary risks of losing, being wrong, leaving money on the table, and missing out. And losing fits into, there's probably a subset category of that, of which I would say is even bigger, a bigger statement than using the word losing, is drawdown. People hate drawdown, the depth of it and the length of it. And this drawdown has been going on for quite some time. I think that peak was August 2021. So we're talking about more than 2.5 years here. But that is not unusual in the markets. The secular bear markets go for over a decade, and during those periods of time, people's portfolios, if you buy and hold an index ETF, that's what happens. You're in drawdown, for a decade, right? And what we try and do is overcome that, even in periods of secular bear markets, and we're going to head into one sometime in the next few years. Is we're going to have this wide-ranging movement of price action, potentially 50% drawdown, run up again, 150% run up, 50% drawdown. That sort of stuff is going to happen, and it's going to happen in our investing lives. And what we need to do is set ourselves up both technically, process-wise, and psychologically to be able to handle that environment. And if you can't handle a drawdown, now I do admit, and that's why we got into some research as to this was a pretty steep drawdown. I'm going to put up a chart in a moment that helps explain that a little bit better, because we continue to do research on this. But if you can't handle this in a secular bull market, you've got Buckley's chance of handling it in a secular bear market, because it's going to happen. And the only way we can actually make new equity highs, new portfolio equity curve highs, is to play the game. It's an infinite game, to stay in the game. And the only way you're going to do that is by not focusing on the money, on losing, missing out, being wrong, and leaving money on the table. Because if you focus on those 4 primary fears, as Mark Douglas called them in his book, Trading in the Zone, you're just going to get taken out of the game. And you're going to stop playing this infinite game. You're going to make it finite based on definitions that are not good for the way that you should set yourself up to embrace risk and continue to execute and play the game. So what happened now, as I said, I take this as a pretty steep drawdown, a deep drawdown, and we went and did a whole bunch of research on that, and we're continuing to do some research, and hopefully we can bring you some stuff in the near future. But you can only come out of drawdown if you continue to play the game, and you will only continue to play the game if you get your mindset right. This is not a technical challenge. There's no possible technical system, process, indicator that will stop drawdown. It's impossible. It's a dead cert it's going to happen. So to go off on a technical, if you like, dead end cul-de-sac to try and solve it with analysis is impossible. You'll never get there. So you've got to solve it with another way of seeing the markets. And that is to redefine and reframe what losing, being wrong, missing out, and leaving money on the table is, and how you build that into your process and mindset regime. So the important lessons to take away here that I mentioned in the email yesterday is that you have to arrange the way that you think such that you can come out of drawdown. Now, in session 5 of the 4-week, the training we put out in November, Dave and I did in November last year, the 4-week process and mindset training intensive, in session 5, we talked very specifically about a skills acquisition plan. And those skills are not technical skills, they're mindset skills. And we set a very specific skills objective to try to achieve in that skills acquisition plan. And it's all detailed in session 5. And effectively, it's to trade through drawdown, 2 periods of drawdown of at least 10% drawdown. Why? To be able to confront all of those emotions that hit you between the eyes when drawdown happens, and to be able to continue executing so you can pick up, you can confront the dysfunctional beliefs that you have as a trader and confront them and overcome them, and then instill a new set of functional beliefs with respect to trading into your mind and into your brain and into your subconscious, your unconscious mind, so that you can come out of drawdown and continue to grow at a rate that's better than the portfolios. Sorry, that's better than the indices. So that's the message I wanted to bring you today. But I also wanted to put into context that I've made 2 big mistakes in that blue line that's come out of drawdown. It, for a period of time, outperformed the S&P 500 and has since been underperforming. Now, that drawdown did take us by surprise, and that drawdown isn't the mistake that was made here. There were 2 mistakes we've made during and since then. The first one, and I have spoken about this, and it's key for me to keep saying this and also for you to understand it, is that the first one was that we ran 2 US real money portfolios simultaneously. And during that time, you may remember it, during that time, we gave at times preference to the second portfolio for new signals that came up. So effectively, we wanted to run 2 mutually exclusive portfolios to see how that tracked. And as a result of that, the other portfolio got first choice at stocks that should have been in this portfolio. And with the research we've done at the time, and why we stopped it, is that was putting a little bit of a handbrake on this portfolio. The second mistake we made is when we moved from 13 to 10 positions, we remained invested, and hence our exposure went down for a period of about 18 months. And that has cost this portfolio in the region of about $10,000 of additional profit. And we'll talk in some time in the future. I'll have a special session where we'll talk about how we should really have done that, because we're doing some other research alongside of that. But despite those 2 pretty major mistakes, if you like, and they weren't timed, they weren't buy or sell mistakes, they weren't mistakes that, we missed signals or didn't take signals, or let lost trades run, or didn't cut profit trades. They weren't those mistakes. These were basically money management mistakes. That's effectively what they were. So when people say, followed the system exactly according to the rules, most of the time when we look at our customers' portfolios, the biggest mistake they make is that they were underexposed for the period of the time. So they got the buy and the sell signals all right, and they were fully invested in terms of number of positions, but weren't fully invested in terms of the amount of money they should have had exposed to the market. So that puts a few things into perspective there. Now, The other thing I wanted to look at was this is a little bit of research we're doing, is we have created a SPA3 investor universe equal weighted. So we've taken the whole universe of all the SPA3 investor stocks, and we've created our own index, and we've equal weighted that across all of the stocks. So the large cap stocks don't get any preference, they don't get any bigger positions. And this is, if you like, similar to the S&P 500 equal weighted index, but not with the whole S&P 500, only with the stocks that we trade with SPA3 Investor, which there's some couple of stocks, a few stocks that are outside of the S&P 500. So we've created our own index, if you like. And we are busy doing some research of that to see how, well, firstly, to explain some of the underperformance during the period that we had drawdown in the S&P in the unleveraged portfolio, and the leverage for that matter, which I'll show you in a moment, but also to see, just to try and explain what happened, but also to see how we can use it. So the blue line is the S&P 500. The gray line is the SPA3 Investor equal weighted index, or universe, if you like. So all of the 60-odd stocks built into that equal weighted positions. Now, this is the period where we had this drawdown here. This, I think it was 34% odd drawdown was the max drawdown that we got over here. So when trying to help us work out what happened, and looking at how stocks in the universe performed, you can see the gray line hit 43.94% drawdown, 44% drawdown, whereas the S&P 500 index only hit 24.5% drawdown. So there's nearly 20 percentage points more in that period of time. And these are the stocks that we were trading. So which helps us explain what happened during that time and made it so tough. Now, the portfolio didn't quite have as much drawdown as an equal weighted index of the universe, the SPA3 Investor universe did, but it should still have done better than the index. We should have still had even less drawdown. I'd say a maximum of half is what we should have had during that period of time. And that led us into doing a whole bunch of research on SPA3 Investor. And what we did is we went and re-optimized the parameters, and we added some new stocks as well. So this relative strength chart over here, just by way of explanation, is just showing that since we hit the trough here, the lowest trough of this drawdown period, is that this rising blue line over here is showing us that the index, the SPA3 Investor Index, is now outperforming the S&P 500, and that's why there's been some catch-up as well. So it helps explain some of the catch-up that the portfolios had. Right, to finish, just to have a look at the leverage portfolio. Now, I do publish this via the portfolio manager, and those of you that are interested in leverage can pull that down and just keep going and looking at what's happening with that portfolio. But it has, to a way, been a little bit of an experiment, but still real money nonetheless. This period over here, so this is the actual portfolio, massive volatility. This section over here was led to more research, but this massive underperformance at the time was running with a 10% margin portfolio, which I certainly wouldn't recommend going into that into the future. We should run with a 20% margin portfolio, and I won't explain all that now. Those of you who are trading leverage will understand that. But huge drawdown there, and this run up, which was partially 10% margin and 20% margin. Then we flattened out, and then we had this big drawdown. Now, this coincides with the 34% drawdown, 35% drawdown we had in the unleveraged portfolio, and also in that period of time, this period of time where the universe underperformed, if you like, the S&P 500, but massive drawdown over here. But coming out of drawdown, we're a long way from drawdown, but this growth has been significant, and that is the S&P 500 total return index with dividends included in there. Now, this is huge drawdown, and I've continued to trade a little bit like Larry Williams did when he had 80% drawdown and didn't pull the plug on this. So didn't continue to trade, remained unflappable, executed 100% mechanically, money management, signals, everything. And the market has turned, and so has the portfolio for that matter. So this is really, although it's a small amount of money, it is only $34,000 US. It's enough to have to really test skills, if you like, to magnify the drawdowns and the run-ups that can happen, to test your mindset skills. And that's what's happened, certainly with me, but it's also testing the system as well. So it's both that's getting tested here. So pretty volatile. And what we want to do with research is minimize this sort of drawdown. This over here is even more exaggerated because of the 10% margin environment, but this was all 20% margin environment, is minimize this drawdown and also allow for the run-ups that we get. So that bit of research is ongoing. And I just wanted to bring your attention to what's happened on the right-hand side over here. Still 57% drawdown, i.e. from up there to there. And I think we hit 80 something over here, which is pretty deep drawdown. And that's, if it's a small enough amount of money that it doesn't mean that much you're not going to lose it all. Why? Because we've got a mechanical system. It'll take you out and eventually take you into cash. But this is a way of really stress testing your mindset. That last little section, starting from September, October 2022, the S&P 500 is up 50%, but this leveraged portfolio is up 230% over that period of time. And that there, I think, was a 33 or 34% drawdown as well, where this went, I think the drawdown here was about 12% in the S&P 500, 12-13%. So that is, just wanted to bring you that as well and just talk about the way that coming out of drawdown, and the only way you can come out of drawdown and grow and test your mindset skills is to continue playing the game and executing. So a few things to come out of this regarding the S&P 500 and the Dow Jones and the NASDAQ 100 and the DAX and the Nikkei all making new all-time highs, despite all the predictions of some high-profile, perennial bulls talking about long-term sideways and going to be many, many years. Is that predicting is a fool's game. It really is a waste of time, of our energy and our resources, which is the definition of fool's game, to put effort and energy into this, because anything can happen. And we don't need to know what's going to happen next in order to make money in the market. And those two of Mark Douglas's fundamental truths are absolutely key for you to, as we say in the 4-week training intensive, to continue repeating to yourself, so that you can, through auto-suggestion, reprogram how you think about the markets. And so keep that in mind. Do not predict. Now, if you do the 4-week training intensive, you'll learn there from James Clear, who talks about, through research of all sorts of historical psychoanalysts and professors and everything about looking at how the human mind works, is that we are hardwired to predict a reward into the future. So the moment we put anything at stake, we predict a positive reward. Now, that is a fool's game in the market. So we have to break that nexus. We have to break the hard wiring, the default wiring that we have with respect to the market. And that means you have to get into a series of experiences, a set of experiences that help change the way that your subconscious works with respect to the market, the way that you are built as a human being. We have to address that. Otherwise, you are going to either make buy-sell mistakes, timing mistakes, or you are going to make money management mistakes, or both, which are just going to hold you back in your performance. So predicting is a fool's game. Even the best in the world do it and fail at it. So bring your attention, as I said before, to session 5 of the 4-week training intensive and the skills acquisition plan. Now, if you go and do that, if you haven't done any of the training, certainly go and do that one on its own. Go and it won't be a waste of an hour of your life, I can assure you. It'll be life-changing, and that might get you to go and look at some of the other sessions before, because the feedback that we're getting from new and existing customers alike of this training is that it's profound, and it certainly is, from our perspective, the best training we've ever put out there. We've got people who weren't customers, who are challenged, who I've known in the game for some time, to come and do it for free, just to tell me what they thought of it. And it's been life-changing for them. 35, 40-year seasoned investors. It's changed their lives altogether, again, in their journey that they have on this game, this infinite game of trading the markets. So I appeal to you, do the training. And the other thing is that those of you who are not still learning to become mechanical, and Mark Douglas tells us, and I push this point in the training, is that subjectivity is research on the go. It's just reacting to the fear of the risks. And until you 100% accept all of the risks in the market, you are going to some degree, operate out of fear. And the more you operate out of fear, or the more that you do not get rid of all of that fear entirely, the more you are going to be held back and not achieve the skills and what the market has on offer to give you. So I'll leave it there. Thank you for your time and attendance today. We'll get this recording out so you can have a look at it again. But these new all-time highs are really a significant step in the markets, and we can only take advantage of what the indices are doing if we are in the game and we have our money exposed to the market. Right, some questions that have come through. So Don has asked, Gary, does the new analysis also include the Australian portfolios? They're a different situation. Now, the Australian portfolios haven't made a new all-time high, so there were no learning, there's nothing to learn out of that at this stage. So they are still going, and I have no doubt that it will at some stage make a new all-time high. That's what I have to trust in and continue over the long term to achieve the goals of what I want to achieve, which is outperform the market. So we can do the Australian in another time, but it's still about I think $13,000 below. It's all about 6%, 5 or 6% below its all-time high. So we'll address that when we get there. So there's no new analysis that we've done here. Don, but you may be referring to the SPA3 Investor Index, if you like. Yes, we are doing that. I didn't show that today because I wasn't showing the Australian portfolio. Okay, EC is asking, what was the new criteria that led to adding new stocks to the universe? It's when we did that in the 2022 and released them about nearly a year ago, coming up for a year ago, was just to extend the universe to give, we have a wide range of customers, different exposure, different portfolios, and also to bring in some more mid-cap type stocks as well, particularly into the Australian market where liquidity is an issue. So the Australian market, we've probably reached the universe that we're going to get to purely from a liquidity perspective, and enough opportunity to have stocks that have been around long enough to have at least 10 years of data and sufficient volatility to do that. So that was the main reason, you see. So Bruce, good point. When I say mistakes, Bruce is reminding that potentially to use the term suboptimal execution is probably a better word. Suboptimal execution rather than mistake. We could debate that one. Raina is saying, should we have a different strategy for what? I don't know what that was for, Raina, at the time. Wasn't looking at it. Marco is saying, could Gary please address the question in Q&A? Okay, so there's more Q&As. Okay, Mark. Raina is also saying, so what would your advice what will your advice be when drawdown happens for people who are getting older? Tough one, Raina. The market runs to its own beat in its own time frame, not to our time frame. So when you're in drawdown, it's the market performance, market direction is obviously going to play a major role in that. So if you're older and you've got less years left, if you like, and particularly if we go into a secular bear market, when we do, then it's going to, maybe you have a lower risk profile, and you could introduce a market risk type shut-off valve for your portfolio, and there are various ways that you can do that. You could watch the public portfolio, and when it gets into a certain amount of drawdown, you could turn your portfolio off, and then when it at a certain time when it starts rising again, turn your portfolio on again. That's one way you could do it, and there are some other ideas that we're researching. But obviously, the market's going to do what it's going to do, and there's no system, there's no process. Even buying index ETFs will probably be the worst, because they're just going to, they're going to continue to fall in line with the market when we get into a secular bear market, and you're going to hit 50% drawdowns on those. So it's, you can't shoehorn your requirements, into how the market's going to go in the long term. So it's it's a difficult one, but you'd need to be your risk profile would need to change from a trading perspective. And just buying and holding stocks obviously isn't going to be the solution as you get further and further into the game, because it's all closer and closer to stopping your active investing, or even any investing, because it's going to there's going to be deeper drawdowns in buy and hold stocks as well. So it's a difficult one to answer, but you're just going to have to adopt a lower risk profile. Marco is saying, Gary, is there a reason why max drawdown was less than 15% 2015, 2021, and then increased to 35% during the last 4 years? Did you change anything in your system? Marco, we did not change anything in the system. When you do research and you come out with the maximum drawdowns, you get we run hundreds and hundreds of portfolios and simulate those over different start dates, different mixes of stocks, different all that sort of thing, and you get what your maximum drawdowns are, and you draw straw broom curves out of that. And everybody writes about this, everybody experiences. I've experienced it. Our research is that your maximum drawdown is always going to be worse than what your research maximum drawdown was. And so we put some parameters on trying to be realistic about what they might be. But it's always going to be worse than real trading. Why? Because you're trading future price action. So you don't have that data set of price action in your research. So that's pretty obvious, but nothing changed. So the only way to explain what happened is that the universe of stocks that we were in, they had a deeper drawdown as a buy and hold equity curve. That's one of the things, and why I showed you that today. And that's why we did a re-research to take the new set of, we want to do this every probably 4 or 5 years, is take a new set of data build that into, and then do some optimization, ensuring that we don't curve fit, readjust the parameters slightly. As you've heard me say, is that there are people that trade futures markets and short-term trade who do that exercise every 3 to 6 months, but they're trading a much shorter time frame as well. And also a more focused set of instruments, either futures markets, large cap stocks, or ETFs, or even indices as well. So that's the only answer. It's one of the risks. There are many risks that we got to face in the market. One of them is just that. If you were trading a mechanical system, no matter what mechanical system you're trading, is that the drawdown you experience sometime in the future, with untested data, is going to be deeper and probably steeper than what you've experienced in research. So hopefully that answers the question. Right. Any no other questions over here? Pleasure, John. Wanted to keep it under half an hour, so questions are taking a little bit longer. So thank you for your time and attendance. And always, I wish you consistent, objective, and peaceful investing.